Hey guys, Mike here. So obviously, another interesting day in the market to say the least, which we'll get into the charts very quickly to see, do we break the 200-day moving average? We get above the resistance, and more importantly, talk about the main thing here is what we relied about too, and I'll go ahead and tell you it was the Fed, something they're not doing, they said they were going to do, and they're not doing it, and the markets have figured it out. And then three, most importantly, why people a lot of money is moving over into tech and anything with risk, to be honest with you. That's where the money's heading, and I'm going to tell you why that is, okay? So it's good to understand that. Now, I'm looking at obviously the S&P chart here, and you can see we are right up against it, and it's so funny to me that, this is happening today because, if you look at it, this is the daily. Again, trillion gaps to fill beneath it, but, it looks like the MACD wants to roll over. RSI, obviously, we're in overbought territory. And, you look at that and you think, we're due for a short reprieve. Will we get that before we cross the 200? Don't know, but there is a lot of overhead resistance, but it's not as bad when you look at the weekly right here. And you can see on the weekly, right there, MACD is looking good. RSI really just barely above 50, which is a bullish sign. And you can see we haven't been above it pretty much all year, just about. And so if we continue up, they're way, way far from being overbought on the weekly. As you can see, on the whole run from 2020, 2021, we were overbought for weeks upon weeks. If you go back before that, same thing was happening on any runs we go on. And again, this comes off, more green days on bad news, more data that come out of China, that their economy is slow and faster than they thought it was going to be when they came out with the retail sales and stuff, and market didn't care, right? Bad news is good news. That's the phase we're in. Then you get this one right here coming out. The Empire State Factory activity plunges down all the way. Look at this big drop over to the right here, down to 08 levels, for God's sakes. That's crazy, isn't it? Just did this huge drop off, negative 31.3, dropped a total of like 43%, right? And you think, well, that's bad, right? And this is the state of New York where this comes out of. And if you're wondering what this is here, all you got to do is look right here, and you can see that the headline General Business Conditions Index plummeted 42 points to negative 31.3. New orders and shipments plunged, and unfilled orders declined. Delivery times held steady for the first time in nearly 2 years, and inventories edged higher. Labor market indicators pointed to a small increase in employment, but a decline in the average work week. And so this is a survey that comes out, and it's just based in New York, because obviously it's a busy state, very heavily populated state and stuff. And so people look at that and they go, wow, look, orders are down, this is down, and it looks terrible, but here's the problem. Why is it down? Because supply chain issues created an inventory issue, as we've seen with Walmart and Target. We'll get to hear about this week. Are they still got that going on or not? Because people, and this is where Kathy Wood was correct when she said people are double and triple ordering because they're afraid they can't get the stuff. And all of a sudden they got all this stuff, and it's like, it took a lot longer to get it. But when they got it, nobody wants it, so to speak, right? It's like Walmart, I think, no, it's Target CEO said, we got the wrong stuff now, right? Because people started changing their buying habits, and they want different stuff. And so now they're having to discount all this stuff. And so, again, does that show the state of the economy is in a bad shape? No, not really. It just, the reason why the orders are plummeting, no different than what I did last week. I was not around the house, had to put the grocery order in. So I put the grocery order in. We'll come to find out I ordered a bunch of stuff we already have. So guess what? Next week, I will not be ordering as much on the grocery list. So we will spend less. And that's what you see happening right now. Again, we'll get to hear a lot about this, and I'll bring it to you on the earnings calls from all these retailers to see what's happening on the inventory side, okay? And so, but you see that, and you think, oh my God, but again, it doesn't matter what news comes out. I remember when I saw that this morning, when I saw the China news. Remember, we're the two biggest economies in the world. We make up, I think it's 45% by ourselves of the world's GDP. I was like, watch this. Markets are going to go green. And I sent to the members this morning in their news briefing. It was red, but in my mind, I was shaking my head. I was like, yeah, it's going to go green. It's going to go green. I'm telling you, the bulls and bears are fighting this out. But it doesn't care, right? That kind of news right now doesn't affect it. If that was 3 months ago, obviously the market would have dropped 3% today, but it did not. And one reason I think this is because they have figured out the Fed has lied to our faces, and the Fed is not doing what they said they were going to do. Okay, and I'm talking about quantitative tightening. They are raising interest rates. But what are they not doing what they said they were going to do? Rolling off their balance sheet, like they said they were going to do. And here's what he said, if you don't remember this, on May 4th, I believe it is.
With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments.
And you got the key word there. He said significantly. Other Fed presidents said aggressively, right? So those are the things I'm taking in context here. And then they said they're going to base it off the employment and things like that. I'm like, last time I looked, employment's pretty hot. The unemployment rate is still going down when they want the opposite to happen. They want to get it up to around like 4%. They're not even close to that right now, right? And so let's see. Here's what I'm talking about. Let's see if they've done what they said they're going to do. It's supposed to be $47.5 billion total was the cap going into June, July, August. And then they want to increase it, right? So we'll get to that in a minute. But let's see here. Let's do the math real quick. So they said aggressively, significantly, whatever word you want to use. So here's June 15th. We start off $8,932,000 on the balance sheet. So that's 32. And then we add 32 plus 21. So over the last 2 months, or from July 15th to August 10th, they've decreased that, by $56 billion. $56 billion and since June 15th. And so I'm looking at that going, wait a minute. Now let me show you what I don't think that's aggressive. And so look at this though. This is aggressive, right? Inflation's booming. This is January 5th. We know inflation's going way up, and look what they did. Look how much they increased their balance sheet by during inflation skyrocketing here, by $200 billion. That's aggressive. If you want to go back to September, I'll show you even more aggressive what they did. As inflation is rising, they're at 8.3 trillion right there. They increased the balance sheet by $600 billion right there, guys. $600 billion. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. While inflation was soaring, but now you're going to decrease your balance sheet aggressively or significantly. And then here we go. We're almost 2 months into this thing from June 15th to here. And the cap's $90+ billion. And you've increased it just half that, right? And then you want us to believe that you're going to increase it next month. You're going to increase to, was it 90 billion total, somewhere in that neighborhood? So you're going to basically double it. Really? Like that's what you're going to do? And here's what I'm talking about. This is, if you don't understand how important running the balance sheet off is and the effect it has on the market. So this right here will tell you, the Fed is pressing on the brakes in an effort to slow the economy and reduce inflation. Over time, this is going to be more impactful than raising short-term rates, which is true. I'll explain that in a minute. The move would have major implications for how much it costs consumers to finance major life events, from buying a home or car to attending college. If things go according to plan, the Fed will have removed more than $522 billion from the financial system by the end of 2022 and $1.1 trillion by the end of 2023. And what's important to note is, like, for every 1 to 1.5 trillion they roll off, it's like an extra 1% increase in the Fed's fund rate in a way, is what they're looking at. But here's the thing, and I think the market figured this one out. When they saw what was going on with the balance sheet, and they're like, they aren't being aggressive at all and run this balance sheet off at all. They were aggressive adding to it, that's for sure, but nowhere near aggressive taking it off. I mean, they're averaging $22 billion a month when it's supposed to be 47.5, right? And so, and then they want us to believe they're going to go up to the 90 billion or whatever it is next month and do that in September, October. But I think what the market really figured out was, wait a minute, it's an election year. If they run that balance sheet off as aggressive, and remember it was March, April, and May, how people were flipping out on Wall Street going, oh my God, because the balance sheet, they'll feel the effects of that way faster than they do the interest rate hikes. And so they're like, whoa, wait a minute, oh my God, they run the balance sheet off, and that was the big freak out. Well, now they're looking at it going, They aren't being aggressive at all with the balance sheet. They're just kind of like just moping along, doing what they want to do. It's not predictable, first of all. It would be predictable if you hit the caps, sure. But I mean, why have the caps if you're not even going to hit them anyway? That would make it predictable. So it's not predictable, and it sure as heck ain't aggressive, right? Why? Because you really want to risk end up having a taper tantrum, whatever you want to call it, and running the market in the ground right before the election. Now, again, the Fed is supposed to be independent, but we all know that's not true. Come on. I mean, if you've ever seen Jerome Powell, I've showed you plenty of videos of him getting asked questions. He's like Fred Astaire tap dancing around them. He's like the best politician of them all when it comes to not getting nailed down to anything. Okay, you've seen him in front of Congress. I've showed you plenty of interviews this man's done. All right, he is a huge politician. And yeah, you can pretty much bet the market said, well, dang, if they're not going to even come close to these caps, we're good for a while, right? That's what they were worried about, was this combination of this aggressive balance sheet roll-off plus the rate hikes. They're just not doing it. And so, therefore, as Jerome Powell said, the stuff they're doing will take effect later on because they're not doing an aggressive balance sheet roll-off now, right? He won't even address that, really, but he did address it. I will say this. Here's what he had to say about this when he was asked.
In September, we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the market should be able to absorb this, and we expect that'll be the case.
No, Jerome, that is the market backing you and your cronies in a corner and calling your bluff. They're tired of doing the work for you, which is why you've seen yields drop off a cliff and people take on risk. And why are people taking on risk? And this is important to know because what part of the business cycle we're in. They realize, as SoFi CEO said, it's going to be hard to come across growth, there we go, in this economic environment, right? So if that's the case, where do you go? What gets the most growth? Well, it's tech. It's, risky stuff like crypto and things like that. And so people have been piling into those, right? I call it the last hurrah in a way, which can last a long time. But I did a video on this months and months and months ago. And it basically shows plain as day when we're in a rate hiking cycle, how there's like this last hurrah to where the markets know, man, when they start freezing rates and then start lowering them, that means we're in a really bad economic time, right? Like demand is just falling off a cliff, which is not good for earnings. And so they say, you know what we got to do? Think about this. If we keep it down here at these levels after we shorted it all the way down and pushed it down, we go across, well, there's not really a whole lot of room to short, right? So what do you want to do? You want to go risk on because the growth is going to slow, which is going to push stuff up dramatically, right? And you want to get to a certain point, and then when we hit those bad times, then we can short it all the way back down and then some. And so, rinse and repeat. They move the money from your account to their account. That's the whole goal in the game. And so that's kind of where we're at. And so, let me know in the comments. I mean, you really think the Fed, who is not even hitting nor near the caps they put from June to August, is really going to come close to those caps they have there in September, October, right before an election? I mean, I don't see it. I don't see it happening. I mean, maybe I'm wrong, and I'll come out here and do a video if I am wrong. Absolutely. But, I don't see no aggressiveness on it. I don't see them, running it off dramatically. I saw them increase it dramatically, showed you that. But I don't see them running it off dramatically at all. And if they do, that's going to be interesting because, again, they've never in the history run a balance sheet off this fast. Nobody in the world has tightened this fast. And so, truth is, nobody knows how the market's going to react. I don't think the market knows how to react, to be honest with you. And again, we've never had tightening around the globe like this. I mean, ever. And so, again, we've never had this much liquidity in the market. So it's a new time. Again, write the textbooks. We're just writing chapter after chapter. Each month is a new chapter. This is a year of first. We've never hit a bottom in the S&P without the VIX being over 45. Guess what? Didn't come close to it. Didn't come close to 45. Yet supposedly the bottom's in, right? Oil's rolling over. Copper's rolling over. All these commodities, why are they rolling over, guys? Because the growth fear. The demand fear, excuse me, not growth fear. Well, growth too, but demand fear, right? Demand's not going to be there because remember, the infrastructure on oil has not been fixed. That problem is not fixed. Those companies are not putting a bunch of money. They're busy buying back stock, paying dividends. They're not trying to do anything about that. They're happy with the status quo, yet now oil is almost half the price it was 3 months ago. Go figure on that. But that's where we're at. Copper, still falling off a cliff. It did have a nice little run back up. But, if there's a fear on demand, that's what's happening. That's why if you see inflation coming down, it's not because, the Fed fixed it. It's like, no, the economy is actually slowing because even even Jerome Powell said they hadn't done anything because he even said, what we've done, you won't feel the effects of that until later on. So if that's the case, well, what did all the work, right? What's going on? Is the economy actually weak underneath all this? Is that what's happening? And so what did the work was the height of inflation draining people's bank accounts. That's what's done the work, especially over in Europe and in China. I mean, I don't trust any of the numbers coming out there anyway, but the fact they even allow something to look negative is amazing, right? And so if they're actually putting those numbers out, can you imagine how bad the real set of numbers is coming out of China? If they would allow it, especially when it comes to their real estate market, oh, I can only imagine. And so, that's where we're at. We'll see. Again, it won't surprise me. I mean, I'm waiting to see if we break that 200, retest, and hold. I mean, why not? You're right there. You're less than 0.2% or something away. Why risk a 08 where it just absolutely breaks through, fails the test, and just plummets? Why wait on that? Because you don't know what the Fed, the hedge funds, and all those guys want to do. That's the problem. It's not about what you want to do. It's not about what retail wants to do. You got to remember, these guys are in charge of the market. These market makers, they're in charge. All right, the Citadel and all them, and whatever they want to do, they're going to do. Because don't forget, monthly options expire this Friday. If there's so many calls out there, do you think the market makers actually want you to finish up? They want all those calls to finish up in the green? I don't think so. So we got, that's another thing. That's going to be a big manipulation day, maybe. We'll have to see on that. That's what happens. Well, you see a lot of volatility around those types of days for monthly options expiration. So that's a whole other thing going on this week. Because I don't think, unless retail data comes out Wednesday and it's just horrific, like something nobody understands, again, bad news is good news right now. So we shall see. That's where we're at, though, okay? That's where I'm going to put it. And so let me know what you're doing in the comments, and I'll see you guys later.